The UK government has this morning unveiled a national semiconductor strategy that will see it invest up to £1 billion over the next decade. The aim will be to boost the UK's strengths in design and research and development and in so-called compound semiconductors. That's semiconductor material composed of two or more elements. It's also aimed at supporting the UK's domestic chip industry at a time when Chinese aggression towards Taiwan is highlighting the risks in the global semiconductor supply chain. Well, join me now, Scott White. He's co-founder and executive director of strategic initiatives at Pragmatic Semiconductor. Scott, welcome to you. I mean, this initiative has been in the pipeline for 2 years. What's kept it?
I think it's a complex challenge, I think, for the UK of figuring out where does it fit into things. You know, we can't really take exactly the same approach that the US and EU have of saying we're going to spend tens of billions of dollars, euros, pounds on investing in bringing advanced silicon node manufacturing to the UK. It just would not actually be a cost-effective thing to do in the UK, and certainly wouldn't be sustainable in the long term. So ultimately would be a waste of money. So I think there's been a lot of effort focused on actually where does the UK have strengths, where can it really play to those, how does it develop those in the best way, and then in parallel with that, how does the UK work with its international allies to ensure that it has appropriate security of supply across broader technologies that it can't play in?
Well, one of those strengths is compound semiconductors. For the uninitiated, what are those?
So as you described, compound semiconductors are basically semiconductors that have more than one element from the periodic table. Perhaps to simplify it even more, it tends to be used as a catch-all term for anything that is non-silicon semiconductor materials. So most of our semiconductor devices today are in the form of silicon chips, but actually there are a number of other materials that can create semiconductor devices that have better or different characteristics. So as an example, we make semiconductor devices that are extremely thin and flexible, so they look like that, rather than being rigid chips. And that means that they can be embedded in a wider variety of things.
Fantastic. What was that made of, the item you just held up?
So we use what's called thin film semiconductor materials. They're basically based on metal oxides, but essentially they allow us to do the equivalent kind of functionality to a silicon chip, but at about 10 times lower cost and with that unique form factor. So in the context of what the UK is trying to solve in terms of supply chains, we can actually replace silicon chips in a number of those critical applications that have been holding up manufacturing of other key products in the industry, but they can also enable new use cases such as embedding electronics into packaging for fast-moving consumer goods. Everything you buy in the supermarket could have a unique identity that can be tracked to allow better supply chain traceability and even things like improving the recycling and reuse of packaging at end of life.
And how did the UK come to have a lead in compounds in this way?
The UK's always had a strong R&D focus in semiconductors. If you go back 20 years or so, we did also have a significant position in silicon, although that has, for a variety of reasons, generally moved out to the Far East. But I think that underlying R&D capability, based in many respects on our world-leading universities and the skills and talent that we built as a result of that historical position in silicon, that has led us to be able to develop these new capabilities. And the challenge now really is how do we make sure that as we develop those into larger scale, that we ensure the value of that is retained in the UK.
We've talked a lot in the past about the way China has cornered the market in certain commodities, for example, so-called rare earth metals. Is there a danger that some of the elements involved in these compound semiconductors, again, China will have cornered the market in them?
There's certainly challenges in many semiconductor materials around the sources of supply, and so ensuring that it's not just about having one piece of the puzzle, but that we look across the entire supply chain of what's needed. I think that's also, though, an area for innovation where some of these newer advanced material technologies can get around the challenges of some of the critical material supply constraints that exist in conventional semiconductor manufacturing.
Scott, we've got to leave it there, I'm afraid. It's good to see you again, sir. Thank you.
Thank you.
And Nationwide Building Society is to hand £340 million to members with whom it has its deepest relationships. The UK's second biggest mortgage lender will pay £100 next month to members who hold both a qualifying current account and a qualifying savings or mortgage account. Well, the news came as Nationwide reported a pre-tax profit of £2.2 billion for the year to the 4th of April. That was up from £1.6 billion in the same period a year earlier and came despite Nationwide reducing its share of gross mortgage lending during the year. Its share of the overall mortgage market, meanwhile, fell from 12.4% to 12.2%. Well, joining me now is the Chief Executive of Nationwide, Debbie Crosbie. Debbie, welcome to you. How many people will qualify roughly for this payout?
Good morning, Ian. Roughly 3.4 million of our members.
Very good. I mean, this is obviously great publicity for you, but I mean, the cynical old journalist in me, Debbie, wonders whether this is a recognition that you've got too much capital on your balance sheet and this is a neat way of handing some of it back.
Well, Ian, all of our profits, because we're a mutual, are retained for the benefit of our members. So what we're doing is we're thinking about the right ways to return the best value. And in addition to the fairer share payment that we've announced, we've also announced a fairer share bond, which pays 4.75, which is available to 16 million members. And that would also be on top of the £1 billion in financial benefit we've already delivered this year. So it's all about returning value because the profits stay for our members.
The fairer share bond is paying 4.75% over 2 years. You have to have your money tied up for that period of time.
Yes, you do.
Right. Looking at the results then, impairments came in at £126 million, I think. What were the kind of loans on which you've been making impairments most?
Yeah, so our impairments are more or less flat. The large majority of our loans are our mortgages and our books, and actually they've been performing well. And despite a lot of the narrative externally, we've seen very stable arrears and very comfortable with that position.
I think at the tail end of last year, you were predicting that house prices would remain more or less static for the next 12 months. Is that still your base case?
So our base case is that we still expect some minor adjustments downwards. We began to see stabilisation. Actually, in our last house pricing index, we saw a very small rise. For me, what that shows is early signs of stabilisation, but I would say that it's going to remain volatile in the coming months, so we're cautiously optimistic.
Obviously, you let your share of gross mortgage lending slip last year from your traditional share. What was the thinking there?
Yeah, well, it's a very small reduction, and really what we saw there is that we saw a lot of dislocation in the mortgage market. It was a very, very competitive market, and we focused mainly on our existing members. We have got great retention. We've managed to retain around 80% of our existing customers, and therefore we felt it was better to focus on providing them the best value rates. But we still supported 1 in 7 first-time buyers, and we're still very optimistic that we're beginning to see some signs of recovery in the mortgage market, some early signs of recovery, but we still aren't back to where we were pre-pandemic.
What about buy-to-let mortgages? Obviously, there are a lot of amateur landlords who are giving up the ghost and leaving the market. What sort of demand are you seeing for buy-to-let mortgages right now?
So buy-to-let demand has fallen, and you are aware, Ian, that it's challenging for landlords. There is a number of difficult issues for them at the moment. Rising mortgage rates have meant that profitability in the buy-to-let market is more challenged. We think first-time buyers, we think that landlords are a really important part of the private rental market and will continue to support them. But right now, we understand that it is difficult for them.
But is that a share of the market that potentially you're looking to grow, or are you basically keeping share where it is right now?
We've seen a reduction in the overall market, so our share of flow we will maintain. But as I say, the market is quite considerably down this year.
Now, what about the savings market? We've talked about the new bond that you've launched today, but I mean, more broadly speaking, a lot of institutions are being accused of not passing on the full extent of the Bank of England's interest rate rises over the last 15 months or so. What proportion of rate hikes have you roughly been able to pass on?
So we passed through about 55%, which is 65% more than the average of the high street lenders. So, we are in quite a different position to a number of the high street lenders. And actually what you'll see in our results is we've got a really strong deposit performance. Our deposits grew overall in the year by over 9 billion. Actually, 6 billion of that was in the second half of the year. So we are seeing very strong performance. And I would also say that what's working really well for us is most of our, a lot of our, 2/3 of our online, of our savings fixed rate bonds are being opened in our branches. 40% of our ISAs this year have been opened in our branches. So not only are our competitive rates driving really strong flows, also the fact that we can offer people the opportunity to come in, sit with our colleagues in the branches and have a conversation is working incredibly well for us.
That's very interesting, because obviously a lot of your competitors are closing branches right now. I mean, you've actually been actively opening them in some locations.
Well, we are really committed to our branch network. We think it's an important part of what we do. And, given we're a mutual, we can make these choices. And it's another way that we return value to our members. And our members have told us that whilst digital is important for convenience, they also want, when it's a complicated issue or when they want to maybe have a conversation about something that's more difficult for them, they do want the opportunity to come in. And that's not just older people, it's also younger people that we found when the issue is complex, they want to be able to sit down and have a conversation with someone that they can trust.
And just going back to this point on savings at the moment, what sort of behaviour are you seeing among your savings customers right now? Are they changing the duration of which they're tying up their money?
What we're seeing, Ian, is that a number of people who historically held balances in their current accounts are being much more focused on the rate. So we're seeing a real shift from balances being held in current accounts and instant access accounts into longer term fixed rate bonds, ISAs, etc. So we're definitely seeing that shift.
We've seen some cases, Debbie, in the recent past of where savings products have been launched on the market, and they proved so popular that the institution involved has had to close them to new customers very, very quickly. I mean, if you get trampled in the rush for this new bond, will you be forced to shut the doors on it?
So first of all, that new bond is only available to our existing members. And that's really important because we want to make sure that we give the best rates to the people who are already part of the building society. We hope that it attracts new members, of course, in the future. But that particular bond is only for our existing customers. But we thought very hard about how we are ready for what I do think will be a very busy period for us. And we've also said that we will only make the bond available for a fixed period of time, and we'll review how busy we are and decide how long we keep that product on sale. But you can open it online, you can telephone us, and we're prepared to open it, or we'd be delighted to see you in one of our branches to open it. But we're looking forward to being busy, Ian.
Do you worry about competition from national savings? I mean, obviously, they've been mandated by the government to bring in more money. They've raised their rates on a lot of products, including premium bonds.
So we pay attention to all of our competition, but we think we offer great value. And as a mutual, as well as offering great value, we hope that people recognise that we can also give back to society. This year, we've been able to donate, as we have in previous years, 1% of our profits. And for this year, that amount, we've donated just under £10 million to good quality causes. So we hope that that really means something to people, and it's one of the reasons that they would choose to put their deposits with Nationwide, as well as the great rates and great service.
Indeed. It's a busy day for your results day. We do appreciate you sparing the time to speak to us. Thanks, Debbie.
Thanks, Ian.
Some other business news stories for you now. And Walt Disney has scrapped plans for two major investments in Florida, under which more than 2,000 California-based employees would have relocated to a new $900 million campus in the state. The move follows a row with the Florida governor, Ron DeSantis, who wants to strip Disney of the right to essentially run Reedy Creek, which is a special tax district near Orlando, which is home to Walt Disney World and a number of the company's hotels. The move comes after Disney spoke out against the Florida education bill, which limited classroom discussion of gender and sexuality. Shares of Smiths Group rose by 1% this morning after the FTSE 100 engineering and industrial technology specialist raised its annual sales forecast for the third time in 5 months. Smiths, which is best known for its airport security scanners, but which also supplies couplings and bearings to the oil and gas industry and electronic components for the aerospace and defence sectors, said it now expects sales growth to come in at around 10% this year. The company, which had previously predicted sales growth of around 8%, said it continued to see strong growth in most of its end markets. The Irish Drinks Group, which owns brands including Tennent's Lager and Bulmers Cider, has replaced its chief executive following a botched systems upgrade. C&C Group, whose other brands include Magnus Cider, said David Ford had stepped down after a systems upgrade at Matthew Clark and Bibendum. Its drinks distribution businesses had taken longer than expected. It said disruptions caused by the delayed upgrade would result in a one-off hit to profits of around €25 million. Well, C&C Group has appointed Rolf Finlay, the former chief executive of the pub operator Marston's, to oversee the transition to a new chief executive. The shares are currently off by some 17%. And the parent company of the Hotter Shoes brand has put itself up for sale. Unbound Group, which targets the over 55-year-old customer demographic, said it had recently been holding talks with its advisors and banks with a view to raising more funds either by a sale of new shares or by extending its borrowing facilities. But it said that as part of that process, it had also decided to initiate a formal review of strategic options available to it, including a formal sale process. The shares are currently down by 20%. Well, another positive finish on Wall Street last night was followed by mixed trading for equities overnight. You can see the picture in the Asia-Pacific region. Both the Hong Kong and Shanghai markets fell amid concerns over the Chinese economy. But look at the top left-hand corner. The Nikkei in Tokyo continued on its recent blistering run, and it's today hit its highest level since August 1990. That was the month I started working in the city, actually. In Europe, equities are also going into the weekend on an upbeat note. Here's the current picture. All of the main continental European markets in positive territory right now. Talking points include Autogrill. The Italian motorway and airport services group is ahead by some 3.5% in Milan as a takeover draws ever closer. Well, here in London, the FTSE 100, it's also in positive territory right now, up just under 0.5% in a broad-based rally led by the mining and energy heavyweights. Among the gainers in the FTSE this morning, well, Flutter Entertainment is among the main one. That's ahead by nearly 2%. A lot of positive broker commentary about that company recently. On the downside, Burberry is off another 3%. That's on the back of its results yesterday. Outside the FTSE, not a great deal of corporate talking points to get into today, but Titan Holdings is down by some 12% right now after rising losses forced the windows and ventilation system specialist to cut its dividend. On the foreign exchange markets, well, the main talking point is that the Chinese renminbi has fallen to a 5-month low against the US dollar. As for sterling, well, that's more or less unchanged against the greenback. It's down by 0.1% against the euro. The single currency, meanwhile, is up by 1% against the dollar. As for the oil price, well, that is actually on course right now for its first weekly gain in 5. Had a good week, a good session a couple of days ago. A barrel of Brent crude will currently set you back $76.26 a barrel. That is up a little over 0.5%. Well, joining me this morning is Neil Wilson, Chief Market Analyst at Finalto. Neil, good to see you this morning. Got to start with Japan. I mean, it's shooting the lights out at the moment, the Nikkei.
Yeah, it is. I mean, Japanese equities have just found favour this year. The Bank of Japan, you got to look at, the global situation here, and, the Fed's raising rates, the ECB's raising rates. Just about everyone is. The Bank of Japan's keeping things super loose there, so I think that's helping. And that's helping to sort of get those risk assets a bit more premium. I think also, investors have been looking for outside of the US. So the US has been the big play for 15 years. Big tech, although that is finding bid this year again. But investors have been searching for some better returns, and Japan has just been one of those markets that's been latched onto. Yeah,
I mean, and company results have not been too bad either coming out of Japan.
That's it. I mean, the economy in Japan seems to be recovering pretty well. You've got inflation actually is up at a 40-year high. So the Bank of Japan is keeping things super loose despite inflation at a 40-year high. That's the sort of core inflation. So it's trending above sort of 3 to 4%. And I think, they're saying, the Bank of Japan is saying that that's to do with imported inflation. But I think, you got to look at the demand side as well. So I think Japan's doing pretty well. Equity market reflects that.
Yeah, I mean, it really does take me back. I mean, the Nikkei peaked. I think it hit its all-time high at the end of 1989, and that was on the back of a bubble. It's been downhill for the last 2-3 decades, really. I mean, it's just extraordinary.
Yeah, I mean, it's that. I mean, you've got a few years on me there. I think I was 6 when that was happening. Japan's gone through this huge disinflation, this deflationary cycle for the last sort of 30 years really, and that has seen it enjoyed a massive run up. That was a massive bubble. That was one of the big all-time bubbles really, and it's been trying to recover ever since, and really struggling to get any inflation. And inflation's quite good. A little bit of inflation's quite good, and that's what we're seeing now.
Yeah, I mean, elsewhere in the Asia Pac region, of course, the renminbi's sold off today. We've had issues with some of the other stock indices as well. I mean, how seriously should people worry about this?
Yeah, so I think China. There's a bit of doubt about China. There's obviously lots of problems, in terms of its financial, the sort of financial system there, the property market there. You had Alibaba results maybe were a little bit soft yesterday, so that seems to have dented sentiment. Well, I mean, the extent to which we can trust any of the data is obviously a little bit, up in the air anyway. But, you had that big China reopening story. It's maybe not playing out entirely as maybe we thought, certainly in terms of consumer demand. But we are seeing, for example, oil demand in China has hit a record high, 60 million barrels per day. So there are signs that China's recovering, but it's the extent to which the People's Bank of China ultimately always comes back to the central banks. The extent to which it sort of helps float things and keep things going. And at the moment, it's trying to keep things quite buoyant, but there are sort of fundamental questions about the economy now.
OK, Neil, we've got the US debt ceiling, which is obviously the other big talking part. I've just been told, actually, that we're about to see pictures from the G7 of the world leaders gathering. Apparently, Joe Biden had a little stumble, apparently. I mean, I think we might even be able to see it. Have a look at that. Oh, there he goes.
Yeah. I mean, he's doing OK for an 80-year-old, I guess.
Yeah, but I mean, here are the live pictures now of what's going on. They're gathering for the so-called family photo there. Neil, I mean, do people, will the dollar start to react if we see things like that happening more frequently? I mean, in the old days, Alan Greenspan used to cough and people used to worry about his health, and the dollar would react on that. Could you see that happening with Biden?
I think it's priced in. I think it's well discounted by the market already that he's an elderly gentleman, and that sort of thing might happen. I don't think that there's a massive risk there. The dollar's moving on so many other factors right now, the Fed and obviously the global, the global economy. I think, the debt ceiling obviously is the key thing that we're looking at the moment. It looks like we're going to get something over the line by June the 1st. And that could result in some further dollar strength. Should we see bond yields pick up? We think probably there's going to be a lot of issuance of new bonds when that debt ceiling deal does get done. That's going to send yields higher. That acts as a kind of tightening in the market, and so that could push the dollar still further. So we think probably the dollar's got a bit further to run now. Interesting. I mean, it is your base case scenario now that there will be a deal over the debt ceiling. I think it's always a bit of a charade. I don't think. I mean, you get to 2011 type scenario that can suck a lot of a lot of juice out of the economy. You get a sort of contraction of maybe even 5% GDP. Should the worst happen in terms of a shutdown, I don't think you get a default. The US is not going to default. I don't see how the US ever defaults. So I think this is a charade, and we play it time and again, and I think we'll get a deal. And you mentioned you think there's a bit more upside for the dollar. I mean, if you look at it against sterling, for example, where does that go? I think you're in a kind of range at the moment. I think we're in a sort of range between, say, 120 to 130 for sterling dollar. We're tracking 124 and change at the moment. I think you could see it, test sort of 122 maybe. But sterling's catching some upside too. It's got some bid because of the Bank of England is going to need to raise rates probably a bit more. The economy is doing better than we thought, but that's why I think probably we're in this sort of tracking this kind of range between about 120 and 130. All right, no, got to leave it there. Always good to see you. Thanks a lot. Still to come here on Ian King Live. I'm going to be speaking to the Chief Executive of Ipswich Town about why the summer months are the busiest for those controlling the footballing purse strings. Stay with us.
I was here last time, I said we were really worried. We'd had a 60% increase on the same period last year. Well, since in that 2-month period, we'd had further fire deaths and further fire injuries, all associated to e-bikes and e-scooters. And I think...
Talk to me about these pictures. What happened here?
Well, you can see the picture here. So the key point I'd like your viewers to take away here is you've gone from a normal morning in a kitchen with somebody charging their e-scooter to an unsurvivable environment in a little under 12 seconds. That, what looks like smoke, is a totally toxic vapour cloud. It has just about every nasty gas, hydrogen cyanide in it you can think of. Really toxic. And then you've got to total flashover conditions. Those flames are over 1,000 degrees and it explodes and puts particles all over your room. And the other thing you're not quite seeing on that footage is that scooter has been charged in a communal kitchen next to the communal escape route for a number of bedsits. So that totally compromised the escape route. Nobody's getting past that. Ideally, charge it outside. Charge it outside or in a garage.
That can be tricky, can't it?
It can, and of course they're quite a capital investment. You know, e-scooters are probably £1,500 to £2,000. E-bikes are over £2,000. So, you know, a lot of people won't want to charge it outside because it's quite an investment. If you are having to charge it inside, that is not ideal. I need to be clear about that. If you are having to charge it outside, don't compromise your escape route. You know, have it somewhere where if it does fail, you can close the door and leave immediately. Get your family, you know, alert your neighbours, get out, call us out and stay out. We've had examples, Kay, you know, around the corner in Southwark, a foldable e-bike. The occupants heard a hiss and a bang and it blew the bedroom door off. And they explode with such force, they've been moving internal walls. So these are really quite volatile things when they go, and you need to be aware of that.
Welcome back. Now, for many football fans, the next few days or so are the real business end of the season, which will decide promotion or relegation, glory or despair. Well, one club that's earned an early summer holiday is Ipswich Town, promoted from League One to the Championship, its first promotion in 23 years. But while the players book their beach holidays behind the scenes, it's the busiest time of year with contracts to be signed and big financial decisions to be made for the next season. Well, joining me now from Portman Road is Mark Ashton, the Chief Executive of Ipswich Town. Mark, welcome to you. I've got to start, first of all, there was an incredible match in League One last night between Sheffield Wednesday and Peterborough. You must be delighted that you're not in those playoffs.
Like you wouldn't believe. I have to say, I watched the game last night. Darren Moore's someone I've known for many, many years. And I was just so pleased it wasn't us going through that anxiety and that pressure. But what a game. What a great advert for the sport as well, for the third tier of English football.
Yeah, so it has been a fantastic season this year. I mean, tell me all about summer for a football chief executive. I take it you don't get any downtime at all.
No. 38 days till the players return for pre-season and 78 days till we start competitive league fixtures. So myself and the staff behind the scenes are very focused. A number of things to do. Player trading begins now as the transfer window starts to open. And then on top of that, we have all the infrastructure projects, major investment here of £2.5 million into new pitch and infrastructure projects in the stadium, and all the financial planning around financial fair play that comes with it. So very busy time for us.
Now, you took a big gamble appointing Kieran McKenna as your manager. He's achieved his success in his first full year. Are you going to be able to hang on to him?
Yeah, I would think so. He seems very happy. I think the stability that we have as a club, the stability that the ownership group brings here, we're well financed and we're moving forward in all directions. So I think Kieran understands the journey he's on in his career. I think we're a perfect fit for each other. This is potentially a huge club with huge opportunity. And to have him leading the team and taking us forward on the pitch is something we're very, very pleased with.
Well, you mentioned that you're putting in a new pitch. I mean, Portman Road already got some of the biggest attendances outside the Premier League last year. Is there much that you can do with the stadium in terms of adding capacity?
Yeah, I mean, we're at 29,500 capacity here with segregation. When we joined the club, you know, average attendances were probably 14,000 in League One. Last season, we were averaging 27,000 in League One, and we were capping out at a lot of games towards the end at 29,500. Just incredible. Before we were promoted, while we were still a League One club, we sold 21,000 season tickets for next season. It's just incredible. The whole club has moved forward. If you look at our retail, for example, historically, even in the Premier League, this football club had only turned over about 1 million-ish in retail. This year, we'll break through 4 million in retail. We averaged to sell around 12,000 shirts per season. Last season, we have sold 50,000. So financially and off the pitch as well as on the pitch, the club is moving forward on a very steep upward trajectory.
You sold 50,000 shirts. That's astonishing. I mean, is that mainly because you got Ed Sheeran, who, of course, is a celebrity supporter? He designed one of the shirts, I think, didn't he?
Yeah, he did. He got involved in the blackout kit, which was the third kit, which was a really good seller for us. Listen, when you've got a world superstar who's a local man, supports the club, supports his local community, sponsoring the shirt and is part of the club moving forward, it can only help. It certainly helps when you launch your shirt and the first night at Wembley, Ed Sheeran rocks up in your new home kit. So he's fantastic, a real big fan of the club and a huge help to us. But I think the whole club has moved forward now at such a pace. You know, season tickets, work in the community, attendances, retail. Again, as I said, it's a very steep upward trajectory that we're on.
Does that mean, though, that you can immediately try and push for promotion in the to the Premier League next year, or is next year going to be a season of consolidation?
It'll be a season of progression for sure. Again, we're well backed. Like all the clubs, there are financial fair play controls in place, profit and sustainability rules that we have to adhere to. But as we do, we trade players. You know, we've bought well. We've bought young players in with value, the likes of Lee Davis, Nathan Broadhead, Harry Clark from Arsenal, etc. Connor Chaplin, who scored 29 goals last season, all young, hungry players with real value. And whilst we've spent money on those players, what people forget is we've also traded players out in the background. And if you look at our net cash outflow for a 3-year period, say last year, this year, and next year, and all the players we bought in, all the players we sold, we're literally net zero. We'll more or less break even on player trading. So while people see what you buy, they don't tend to see sometimes what you're selling in the background. So we have a model, and we'll stick to the model. I expect us to attack the championship well and continue to buy good players that give Kieran McKenna the very best opportunity to be competitive.
Now, I hate to rake over old coals, but before you joined Ipswich, you were 5 years at Bristol City, where it's fair to say some of the supporters think the club could have done a bit better under your stewardship. What's the case for the defence?
5 years at Bristol, amazing time. You know, we finished consistently just outside the playoffs. Stadium was completed, training ground was built, Carabao Cup semi-final. I have a really good relationship with the ownership group there. In fact, Ipswich get promoted, and the very first person that texts me and congratulates me is Steve Lansdowne, the Bristol City owner. So I think that tells you about the relationship I still have. As a CEO, look, you take the bullets. Sometimes things will go right, sometimes things will go wrong. I have very fond memories of Bristol City. They're a fantastic football club with incredible owners, and I'm sure they'll be ultra competitive next season. And I look forward to seeing the owners there for a drink when we see them.
Yeah, nice. You're a class guy, Steve. Mark, all the best to you. Good to see you this morning. Thank you.
It's a pleasure. Thank you for your time.
These are the latest pictures that we've all been waiting for. This is the family photo for the G7 right now. This is in Kushima in Japan. Obviously, the main body of the meetings is being held at Hiroshima itself. There's Olaf Scholz that we're looking at there, Rishi Sunak, Ursula von der Leyen from the European Union. Not sure what that music is in the background. It's something traditionally Japanese, I suspect. There we go. At least it stopped raining for them. It's been very miserable over there the last 24 hours or so. Now, the rise of artificial intelligence is like a freight train heading towards the workforce. That's what the chief executive of one energy company has told Sky News. It comes after BT announced yesterday that around 10,000 jobs will be replaced by advanced AI in the next 7 years. Our business correspondent Paul Kelso reports.
I would definitely say that's something that we should do. When you pick up the phone to a company, this is what you hope you'll get. A human to help.
Sure, I can set that up for you over the phone.
But send an email to Octopus Energy and the answer might now start with artificial intelligence. It's answering 44% of customer emails just 7 weeks after it was introduced.
It's read every email we've ever sent to a customer. It's read every training manual we've ever used with our team. It's read every bit of regulation. I mean, it's read every bit of the arcane back end of energy. It kind of just knows it all, right?
The boss says AI won't cost jobs here, but it is a threat to workers in the wider economy.
Around the world, governments are quite quickly beginning to think about what they have to do here. But we haven't got time to wait and see because, look, if a freight train's coming at you, you don't wait till you feel it hit before moving out the way. That'll be too late.
Generative AI is changing the workplace fast. This London law firm has a bespoke AI tool being used by 3,500 lawyers in 43 countries just 3 months after it was launched.
On an individual basis, it's a boring productivity gain, really. It's an hour or two a week, but when you multiply that by 3,500, that is a big deal for a business.
What, before this existed, would that have been a realistic target if you'd been asked to find, go off and find me 3,500 hours?
It's impossible. It was impossible to find these productivity gains through a single deployment of a system a year ago. We couldn't have done this.
Job losses are inevitable. BT says it will replace 10,000 workers with advanced AI by 2030, and they won't be the only ones. Government has no plans to legislate, but unions say rapid adoption of AI threatens workers' rights.
We say that at the very moment at which regulation is most needed, when the technologies are developing so rapidly and the implications are so significant, instead of regulating, the government is putting forward flimsy and vague proposals that don't have any statutory footing.
Artificial intelligence could trigger an industrial revolution for white-collar work, with the prospect of huge productivity gains coming with warnings that millions of jobs might cease to exist. But the technology is moving so fast, we can't know where that balance between promise and pain will settle.
AI will create new roles even as it consumes old jobs, but the speed of change is fast turning science fiction into a fact of working life. Paul Kelso, Sky News.
Well, we're going to stay with AI now. Earlier in the week, we spoke with Luminance. That's a company that uses advanced AI for the processing of complex legal documents by corporate customers. But it's not the only player in that particular field. Orbital Witness, a technology platform using AI to make buying commercial property simpler, claims it's already been used in 76,000 transactions. Today, it's announced it's raised £7.5 million in a Series A funding round. Joining me now is its co-founder and chief executive, Will Pearce. Will, what is this value at now, roughly?
So at Orbital Witness, we're really proud of the progress we've been able to make. We have some very large customers. We have some of the largest law firms in the world, over 2,500 real estate lawyers using Orbital Witness every single day. Our customers range from FTSE 100 listed retailers through to large energy infrastructure companies, and we're really proud of this £7.5 million Series A raise.
OK, and roughly how much is that value at?
We're not going to disclose the precise value, but we're really proud of the funding round that we've accomplished.
So what are you going to put the proceeds towards?
Sure. So we're doing a lot of job creation. We have 45 people here in our London office, a lot of data scientists, a lot of software engineers. We're roughly doubling that number in the next 12 months. We're launching a new product. You mentioned our progress in commercial real estate, Ian. We're now launching our technology for residential home buying, so working very closely with property conveyancers in the home buying and selling process. And then thirdly, we're spending a lot of time in new applications. So we're looking at how automated diligence, understanding legal issues straight away in a transaction, can help estate agents, can help mortgage lenders, can help anyone involved in the world of property.
Are the processes involved in buying commercial and residential property replicable?
Well, there's a lot of nuance that is specific to commercial, but the underlying documents, the underlying understanding of what a legal risk might be, a particular legal issue, can be quite similar. So to give you a few examples, in residential conveyancing, in home buying, a risk might be something very financial. It might be an onerous service charge or ground rent related to the flat you're buying. It also might be something quite emotional. It might be whether you're allowed to have pets in the property. But in commercial, it's a very sophisticated industry. Commercial real estate is an exceptionally large asset class, a lot of the risks there are very financial in nature, relating to security of rent reviews and rental income streams, for example.
So with the residential product, will you be looking essentially to save clients time or money, or both?
Well, both primarily, but it goes further than that. I mean, commercial real estate is a very emotional journey that people go through. Buying a home is everyone's highest value, most stressful, most emotional purchase they'll make in their life. And there's a huge value proposition in residential just to give people important information up front. So we're saving time, we're saving money for the residential conveyancing solicitors, and introducing a lot of peace of mind, introducing a lot of certainty for everyone involved in the property transaction by giving them important information.
You heard that report yesterday from BT, 10,000 people essentially going to lose their jobs due to AI. I mean, are you looking to put people out of work, or is that just a byproduct of what you do?
Absolutely not. I mean, there's a ton of different jobs that will be created with AI. What we're really focused on at Orbital Witness is how we can use artificial intelligence to speed up the property purchase process and to give people important information about real estate. As I said at the beginning, we have a lot of really fantastic customers that we're really proud of using Orbital Witness. We've been used on about 1.5% of all UK property transactions this year. We spend a lot of time with our customers speaking about our vision, and they love the work that we're doing. A lot of lawyers didn't go to law school to read stacks and stacks of paper. The average commercial property deal can have about 1,200 pages of documents to review. It's the same as War and Peace by Tolstoy. So a lot of these people are really excited about the work that we're doing to speed up their jobs.
You've mentioned the solicitor side of the process. I mean, one of the other real sort of things that throws grain into the wheel of a house purchase is local authority searches.
Yeah.
Is this something that you're going to be able to help tackle?
Well, I mean, to some degree, yes. There's always going to be a kind of a problem of getting hold of information. So local authority searches rely on a local authority having information that they can distribute to the property purchasers. A lot of what we're doing is then analysing that local authority search using artificial intelligence, as well as lots of other documents from the land registry or planning permissions, for example. So the review of the particular search that you're talking about, Ian, is where Orbital Witness will be used, rather than the acquisition of that information in the first place.
All right. And how was the company born?
We have a pretty fun origin story. Myself and my co-founder Ed started life in the space industry.
Right.
We were spending time as young entrepreneurs in the space industry, which is where the name Orbital comes from. As part of that journey, we found ourselves in the London offices of a large London law firm, and to be frank, we were shocked with the stacks of paper sitting on people's desks, the amount of hours that some of these lawyers were working to, the delays in the transaction, that the client just wanted to proceed with the deal. So we're outsiders to the real estate industry, and we're really excited about the problem that we're solving.
All right, well, good to see you this morning. Thank you.
Thank you very much.
Bit of breaking news that we can bring you, which is that Timothy Schofield, he is the brother of the TV star Philip Schofield. He has been jailed at Bristol Crown Court for 12 years after being convicted of 11 sexual offences involving a child. We'll no doubt have more on that throughout the morning here on Sky News. In the meantime, some more breaking news for you. President Zelensky has arrived in Jeddah to attend the Arab League. That is a report from Al Hadath TV in Dubai. President Zelensky arrived in Jeddah on Friday for the Arab League summit. Al Hadath TV is actually owned by the Saudi government. He arrived on a French government plane, and this, of course, comes amid reports that he is going to attend the G7 Leaders Summit in the city of Hiroshima this weekend. So lots of interesting developments there. Obviously, he is going to be pushing for the US in particular to start supplying F-16 fighter jets to Ukraine. I'm sure we'll have more on that throughout the weekend here on Sky News. But still to come on Ian King Live, we're going to be having a look at what's in today's business pages next with Neil Collins from the Evening Standard. Don't go away.
When I was here last time, I said we were really worried. We'd had a 60% increase on the same period last year. Well, since in that 2-month period, we'd had further fire deaths and further fire injuries, all associated to e-bikes and e-scooters. And I think...
Talk to me about these pictures. What happened here?
Well, you can see the picture here. So the key point I'd like your viewers to take away here is you've gone from a normal morning in a kitchen with somebody charging their e-scooter to an unsurvivable environment in a little under 12 seconds. That, what looks like smoke, is a totally toxic vapour cloud. It has just about every nasty gas, hydrogen cyanide in it you can think of. Really toxic. And then you've got to total flashover conditions. Those flames are over 1,000 degrees and it explodes and puts particles all over your room. And the other thing you're not quite seeing on that footage is that scooter has been charged in a communal kitchen next to the communal escape route for a number of bedsits. So that totally compromised the escape route. Nobody's getting past that. Ideally, charge it outside. Charge it outside or in a garage.
That can be tricky, can't it?
It can, and of course they're quite a capital investment. You know, e-scooters are probably £1,500 to £2,000. E-bikes are over £2,000. So, you know, a lot of people won't want to charge it outside because it's quite an investment. If you are having to charge it inside, that is not ideal. I need to be clear about that. If you are having to charge it outside, don't compromise your escape route. You know, have it somewhere where if it does fail, you can close the door and leave immediately. Get your family, you know, alert your neighbours, get out, call us out and stay out. We've had examples, Kay, you know, around the corner in Southwark, a foldable e-bike. The occupants heard a hiss and a bang and it blew the bedroom door off. And they explode with such force, they've been moving internal walls. So these are really quite volatile things when they go, and you need to be aware of that.
Tap into the latest news and insight. Invest in your future. Sky News Financial Reports, sponsored by Interactive Investor. Invest in your future. Sky News Financial Reports, sponsored by Interactive Investor.
Time now for a look at this morning's business pages, and the Financial Times splashes its print edition with news of the BT job cuts on which we reported this time yesterday. The paper's Lex column says it sounds a big number, but points out that most job losses will result from the completion of BT's rollout of fibre broadband. The FT also carries an interview with the influential investor Carl Icahn, in which he admits he was wrong to make a huge bet in 2017 on crashes in a number of financial markets. The bet cost his group $9 billion over roughly 6 years. The Times leads its business pages with the UK government's semiconductor strategy announcement, but it also reports that the fintech company Revolut's attempt to secure a long-awaited banking licence is in doubt after it emerged that the Bank of England is minded to reject its application. Well, that story makes the lead in the business pages of the Daily Telegraph, which also reports on an assessment yesterday from the Office for Budget Responsibility that the age of massive house price increases may be nearing an end. The OBR says this is due to slowing population growth and interest rate rises. Well, joining me as ever on a Friday morning is the financial markets commentator and Evening Standard columnist Neil Collins. Neil, good to see you this morning. Well, obviously, one of the big stories this week was Stellantis calling for the deal between the UK and the EU post-Brexit to be renegotiated. What did you make of that?
Yeah, the trouble with the motor business is that it's full of emotion. And because it is so obviously in people's minds, people know what a car is. They like to know where they're built, and where they're built is extremely important in terms of the value chain. It's almost impossible for governments to stay out of this. Indeed, following Stellantis's comments and requests, demands, call them what you will, for financial assistance, we've now got a story today that Tata, the owner of Land Rover and Jaguar, are asking for up to 500 million in assistance to build a battery plant in the UK rather than in Spain. And this is it's pretty grim, really, because there is something approaching a a subsidy scramble here, not just in the UK, but across the Western world, with the understanding that because batteries are so heavy, they're very difficult to transport. So they really do need to be where the cars are being built. And so both the US and the EU have committed themselves to very substantial subsidies. I fear, though, that this is not a very encouraging race to the bottom, because the subsidies are all very well, but the underlying problem that the European and to a lesser extent the US car industry has is the cost of energy. Europe, including the UK, is committed to essentially being high energy cost economies. For better or worse, this is the result of the greenery. Whereas in China, they have understood the need to keep energy costs low. And I'm afraid that they are a long way ahead in the development of cheap electric cars, because essentially they are guaranteeing cheap energy. And that is something which no number of government subsidies here and in Europe are going to overcome. So I fear that we are going to see the eclipse of the UK mass market manufacturing industry, and in future, the cars on UK road, the electric cars anyway, on the UK roads will come from China.
Indeed. While you've been talking, Neil, we've been showing some pictures of the G7 leaders. The G7, obviously, its heyday was in the 1980s, when those economies accounted for getting on for 70% global GDP. Is it still relevant these days, do you think?
Well, it's not irrelevant, but there's no question that the economic centre of gravity of the world has moved to the east, and particularly the Far East. That is where the world's fastest growing economies are. That is where there's the most dynamism. There's often the feeling that in the West we are more concerned about trying to preserve what we've got rather than trying to look ahead and grow the economy and stay in our position as one of the emerging or the most emerged countries. I think this is not confined to Britain. I think it's across Western Europe to a greater extent. So there's a limit to what we can do to fight that. So is the G7 still relevant? Yes, of course it is. But it's nowhere near as dominant as it used to be.
Yes, and that ties in very neatly with the comment you were making on Chinese car manufacturing just now. Neil, got to leave it there. Good to see you this morning. Thank you.
Pleasure.
Well, just before I go, a reminder to check out the Inkin Live podcast. You can find that by scanning the QR code on your screen. Right now, it's available wherever you get your podcasts, including the Sky News app, Apple and Google Podcasts, and Spotify. And you can also find plenty more business news on our digital platforms. Right now, I did a piece yesterday on the Water UK announcement and why it's taken so long for the industry to get round to tackling these sewage spills. Do have a look at that if you can. Well, that's it from me for this week. What a week it's been for the Japanese stock market in particular. I'm back on Monday morning at 10 o'clock. Hope very much to see you then. In the meantime, do stay tuned after this short break. It's Sam Washington with all the latest from the G7. Have a good weekend. Cheerio.